Welcome back, guys. Last time I had mentioned about how to look at the economic calendar and uh, make your plan for the week in advance. This is something which you have to do over the weekend while the markets are closed. So I'll do it in front of you right now. So what I have done is I have just taken a screenshot of the weekly news there, and I'll just paste it on a new page right now. So the way I analyze this weekly economic news is basically to decide which are the days and which are the sessions which I should be trading in, and which are the sessions that I should stay out from. So the very first thing that you need to decide is should you trade on a Monday or not. As a norm, you can very safely consider that Mondays are not high probability days to trade in. Just give me a minute. There's a call. Okay. So, as a norm, we don't look for trading on Mondays. Logic is there have been 3 days when the market was not functional, and there could have been some events that have happened over the weekend, which have some sort of impact on the economic landscape. So, all those things are a sort of uncertainty which the market has to balance out. So mostly on Mondays, what will happen is those people who are trigger happy, who want to immediately involve themselves in the market, they will start jumping in, and that is when the market becomes choppy. So you don't want to be part of that chop in the initial stage of the week. So it is always advised to skip Monday's morning session at least. If you have to trade, you can look for a trade in the PM session. But there are certain rules around trading on Monday specifically. Those rules specify that Monday is a good day for trading. So one of that was told to you in the very first lecture when I mentioned that first week of every month generally has non-farm payroll event scheduled on Thursday, first Friday. And I also mentioned certain high impact news which are very, very important, like federal funds rate or FOMC statement. So, whenever these kinds of news are scheduled later in the week, or later means Thursdays or Fridays, on such days, Monday is a good day to trade on. Now, even on Monday, when or which session you should be trading in, also has some definitive rules for it. Like last time I mentioned, since there was no news at all during the entire morning session, it was better to trade prior to uh, the opening of markets, that is prior to regular trading hours. So the better time to trade was from 5:30 in the evening till 8 o'clock. So that is when there is no news at all. But when there is a single news like today, a high impact or a medium impact news, then you should be trading after that news, because that is the news that will bring in volatility in the markets. So we should definitely be looking for a trade during 8:30 to 9:30 p.m. on this calendar. So this is when we'll be looking for a trade. So that opportunity may present itself within this hour, or we may have to wait for 9:30 to 10:30. Now, you have defined a trading session and trading time for uh, your trading activity. So that is what we arrive at by analyzing this chart. Now, I'm not going to go into every day over here right now, because we are already into the regular trading hours. So we'll continue with this at the end of it. Now, let me also take your attention to the charts. The routine that we follow for marking all the charts is the same. Every single day when you open the charts, you want to know where the new day opening gap is and where the other inefficiencies are. So you need to be on electronic trading hours, and I'll also increase the number of days for previous data to be loaded. By default, it is just 5 days data that is loaded on the chart. Okay. So now this is the new day opening gap that is highlighted. I just delete this part. Okay. So this candle's closing price and this candle's opening price will make the uh, new day opening gap. Just mark it and use the template that I have already saved for new day opening gap. The first line I mark it as blue line, and the second one red. Opening range gap. Sorry, this is supposed to be NDOG. The other one is supposed to be opening range gap. Now, why I use this opening range gap template for this is because that price is also influential for demarcating the opening range gap. The opening range gap is basically previous day's close and regular trading hours open to the opening price at 8 o'clock. 8 o'clock, the opening price here. 801. This is the candle which begins the regular trading hour. Market. This is part of the opening range gap. You can notice already that opening range gap today is very, very large. I had earlier defined the range which I like to trade in. So if you see from here to the previous day's close, this is the opening range gap and this is the midpoint of it. Put a horizontal line here. So you can see the gap is almost 800 points, which is rather very, very large. So you don't want to use your opening range gap technique over here, wherein you look for price to reach up into that midpoint within the first half an hour. First half an hour is from 8 o'clock to 8:30, but it is still trying to show us that. Balance here. Look at these relatively equal highs over here. Price. Even here it is relatively equal highs. It does look like it wants to reach up into that, but I'm not going to force that idea right now. We also should be noting the first fair value gap of the day. That happens after this candle. So this is the one that I see. Use this candle's high. I'm also encompassing that you know, the volume imbalance inside that first fair value gap. There is a small gap between these two candles. When you look closer, although it is just one single tick over here, but that is an inefficiency. So that needs to be considered inside this fair value gap. So basically, we are ignoring this wick for fair value gap. Had there been no gap over here, this box would have, been to this box. That's the first fair value gap of the day. We'll extend it for 3 days ahead. The way I do it is over here, I just change the date from 27, 28, 30. I'll just change it to 30. That should extend my first fair value gap for 3 days ahead. If you want, you can change the color to demarcate this fair value gap in a different color so that it's too bright. Yeah, can be. Okay. This is the first fair value gap of the day. Also, an inefficiency. Use another chart because this will too busy over here. Now, over here, you can see these dotted lines over here. This is basically automated way of marking the new day opening gap. So this line is basically denoting the new day opening gap. And this, all these are new day opening gaps, which are all above the price right now. So on the daily basis, you can see it has just slid lower continuously and it has gone below this candle's low, but this one has not been reached. Just below that is the this swing high and this swing high, and we also have one volume imbalance over here. So there is a large pool of sell side liquidity below this level over here, the downside, and we have a large buy side liquidity about this high and this high, because even they are relatively equal. And since this is a range that is held on the daily time frame, especially during the weeks like this week, we have federal funds rate. You notice this is a very, very important event for the US dollar and US economy. So whenever we have this kind of a event which is on the horizon, the price tends to be kept coiled up inside a tight range, and that only generates the buy side and sell side liquidity. So price will stay inside this range for all the time, and the moment the news is released, then both these liquidity pools will be tapped. So price, if it has to go higher, it will come down, take out this sell side liquidity, and then immediately start running faster towards this side. Or if it is to go lower, it will just go upwards, disturb this buy side liquidity, and then start going lower towards this. So this is a typical characteristic of price on such weeks when there is a high impact news that is due out uh, later in the week. That doesn't mean that you cannot take any trades during this week. It's just that you will know as to what those boundaries are within which this price is trying to stay. So don't overstay your welcome when you are in a trade. When you find your targets, just uh, book the profits and get out. Increase the number of candles over here. 20 days. What I want to see. Okay, so on 120 minutes basis, you can see all these candles have been all down close candles. After this sell side liquidity has been tapped into, the price has retraced back inside this range. Mm. So whenever you have this, hello, you want to
मेरा
ask
थोड़ा
something?
रेजोल्यूशन क्लियर नहीं है.
नेट स्लो है इसकी वजह से मे बी.
मतलब शुरू से ही आपका रेजोल्यूशन नहीं ठीक आ रहा स्क्रीन.
तो ठीक चल रहा है. आवाज आ रही है क्लियर?
आवाज क्लियर है.
मे बी नेटवर्क का इशू होगा, बट आई थिंक रिकॉर्डिंग विल हैव इट क्लियरली इन इट. बिल्कुल ही कुछ नहीं दिख रहा है या मतलब थोड़ा सा हेजी है?
थोड़ा आइडिया टाइप में ठीक ठीक है. नॉट दैट.
ओके.
और मैं साथ में अपना चार्ट चलाया हुआ.
अभी 120 मिनट्स का चार्ट दिख रहा है.
यस.
ओके. So I'll just give a small this thing kind of orientation of this kind of price structure, wherein you can see on on the left side, if I start from this bottom, the price has in a sustained way gone higher, and then it has gone inwards into the entire range over here. But if I draw a vertical line at the topmost portion over here, if you consider this as the topmost where the price has gone from down here upwards, then all this price delivery is called as buy side price delivery. Buy side price delivery. And everything after this vertex that goes downwards, this is sell side delivery. So for the algorithm, both buy side and sell side have to be in balance. It matlab that is the way the efficiency is defined in markets. So for everything that goes up, there has to be equal delivery on downside also. So when price went higher, it had created those stair steps. Like I said, in a buy program, you want to look at all the down close candles that form. So if this was all buy side price delivery, all these down close candles were supposed to support price and send it higher. So to start with, you can see over here these two down close candles. If you extend the opening price of the upper down close candle over here, you can see when price came down into it, it could not push below these down close candles. And then again it went higher. So in this price structure, you can see now after these two down close candles, successively we have this large down close candle over here. So now the price has come down into it. The wick has gone below this price, but you can see the bodies have stayed at the midpoint of this down close candle. So this is a way in which it is indicating that this has supported price. And now you can see all these down close candles while it was going higher, they have supported price. If you see all these three down close candles, there is no white one in between these. So we will combine them as one and extend the opening price from here ahead. You can see when price comes down into it, it gets supported and then the price leaves from here upwards. So this has acted as support while price went higher. You can see that evidence over here. So when price goes below it, then this should act as resistance on the sell side. So when it comes back up into it, we want to see if this area can restrict price from going higher. Why? Because while the price was going higher on the buy side, it was used as support. We want to see a characteristic of inversion. Now, inversion is when the role gets reversed. So I'm trying to find an evidence that this portion has changed its role, that is inverted its role. Inverted from where? That while price was going higher, this acted as support. So I now want to see it as resistance. So I want to see this as inversion. So inside this price range, we have this fair value gap over here. And on the higher end, we can also have one more fair value gap highlighted on 120 minutes basis with this high as the place where buy side liquidity will be resting. Let's get down a bit. Also similar actually. So on 90 minutes basis, we have just this single down close candle. We can recalibrate this over here and just highlight this single down close candle. And you can see price has dipped into it from here, it has gone higher. So when you extend this ahead, we have this fair value gap over here. and small down close, what you can call this as the fair value gap. So this is where we expect that resistance to come in. Let's get down to 60 minutes. So on 60 minutes, you can see these two are two separate candles. On 90 minutes, this was just one single candle. So whenever we have similar colored candles which are next to each other, you can combine them together to, consider them as one. So inside this space, we have this imbalance. And now over here, I can see, if you see these candles, one, two, and three, we have their wicks touching each other over here. So the first candle and the third candle, they are touching each other. If I show you closely, trust me, I'm going somewhere with this. Don't think that I'm just trying to indicate things which are not useful. So look at the low over here, this price. That is 21,411. That is the low on this candle. Look at the high of this candle. This is 21,412. So 411 and 412. So these two candles have touched each other. So by 1 point, this candle has gone higher than this low. So this criteria over here, or this phenomenon, is called as immediate rebalance. Very, very important for reading the or tape reading, uh, particularly. This is called as immediate rebalance. Immediate rebalance means when price is being delivered on the downside or rather upside also, then between these three consecutive candles, the price does not leave any gap and it delivers back to the lowest where the brush had been painted. So when this candle was being painted, it was painted down till here. And when it left from there, the next candle comes back up and covers this place. So this portion has been rebalanced immediately in the next candle. So this immediate word comes from the immediate next candle, which has come back and delivered to the bottom of the previous one. If you are looking at it from the buy side delivery perspective, then this would have been reversed for up close candles. And I'll show you that example also a little later. So now when this thing happens, the price has been sufficiently delivered back to the previous one. So you don't require price to come back over there and then it starts running towards its target immediately. You can see there is a large candle after that going downwards and none of these candles come back this side. That's an indication that there is no requirement of price coming back to the immediately rebalanced level. So it just runs towards liquidity. So that is what has happened over here. So now after this, where is the inefficiency? Because this portion has been balanced. So we have an inefficiency after that, which is below this candle's low and above this candle's high. So that's the place where we have an inefficiency in price, this low and this high. That is where the price has come back into, and it is, if rather exactly in the midpoint of that imbalance. So let us color it a little differently, just to know that this is the 60-minute fair value gap. Okay, and let us expect even this to resist price. Okay, and we have a balanced price range over here. Just remember earlier I had shown you there is a wick of this candle here, and the next candle's body goes through that wick and closes lower. So anything above that wick to this body, this is the balanced price range on a 60-minute basis. I'll just highlight this and give it a different color just to demarcate that this is the balanced price range. Let's make it so. This is the balanced price range. So right away you can see that there is a lot of resistance if the price has to go higher from here. And this is coming from the 60-minute chart. So on the higher time frame, we have a lot of reasons for price to be stalled over there. And that balanced price range you can see on a 15-minute basis, this is an up close candle. So on the sell side, we are looking for these up close candles to act as resistance. Okay. We are past that 8:30 news right now. Let's see how price has reacted on the lower time frames. They're relatively equal highs. And on 4-minute basis, you can see there is a small fair value gap there. Now, I have done these higher time frame markings. I would want to see them also on the 1-minute chart that I have. So what I'll do is I'll just select this box, go into properties, and now I will mark this one, all charts. So this selected area will show on all the charts that I have opened. That's just to make it easier for me to transfer all these levels back to the chart from where I'm trading. So I have transposed these two levels onto the 1-minute chart that I was following. Now I'll again take it back to the 15-minute chart that I had opened and I'll put it aside. So those levels now are back on my chart over here. So this golden patch, this is basically the first fair value gap of the day. 8:30 was the first, or rather the only news that was supposed to be released today. So it is behind us now. Now after 8:30, I want to see where is the first fair value gap forming on the hourly basis. So you ignore this 8:30 candle, and from 8:31 onwards, we start again looking for that first fair value gap. So you can see this area over here. Color it differently. Oh, okay. For the hourly, I have made a template over here. Let's use that. 31st hourly. Yeah. Sell side liquidity over here and here.
Order filled.
It's okay. It can come back to the bottom of this candle. That would act as immediate rebalance. Doesn't. Good. Sell side.
Target filled.
Partial is taken now. Sell side here and here. We want to see price closing below this belt. This would be the first fair value gap of the day. So if price closes below it, then it would be going down for this liquidity. We have a small fair value gap here, which if it remains open, it's good for this trade. Here. By-
Order filled.
So of the two micros, I have taken a partial at this low. Now I'm not bothered if the price comes back and takes me out. I would now expect it to start expanding with larger bodies down to this low. It has taken the minor sell side liquidity below this low, but we still have a larger liquidity pool below this one. this gap remaining open is a good signature that it can extend down to this one. So I'll just get my stop down below the entry. Now I want to see this midpoint of this uh, belt to resist price and not allow it to go above this. Rather, this stop should remain safe. You see this belt and divide it into half. So I don't want to see price going above this midpoint. I want to see this act as resistance. See, the body has not closed above it. So that midpoint has been respected in this candle. Now go back into this imbalance again if it closes above it. Again, the second one also did not close above it. Now I want it to expand with larger bodies downwards. And now I trust that the price delivery above the midpoint is done. It need not come back to this high again. If it does, I'm okay with me getting stopped out over here. Then now watch this imbalance. This is where the price is looking to go up into. Like I said, if the price closes above that midpoint, it can go into this imbalance. So it was better to get stopped out here. Now we have these two relatively equal highs here. If the price closes here, you can expect it to run above this high into this red colored band. So far, that first fair value gap is being respected. So even from where it is right now, 316, this high, it's a good distance price to reach up into. Mhm.
Order filled.
I'm using that first hourly fair value gap as the filter. That the price had gone lower for the sell side liquidity here, and now it is running up for this buy side liquidity. You can see this candle's low has stopped dead at that low. This level has flipped the delivery of price from sell side to buy side. This high has been taken out. It's okay. Okay.
Hello.
Now shoot up here.
Target filled.
So that's price delivery on both sides. So this price closing above the first fair value gap of this hour. This was an indication that it doesn't want to go lower, at least for this hour. That's my way of interpreting this. I had initially mentioned that I use this as a kind of filter, and you can see how neat the price is. You can see this candle's low did not go even one tick beyond that first fair value gap. So that's the kind of precision these levels give you. But you have to know what those levels are and what you are looking for. You can see, if you remember, I had mentioned on the 60-minute chart, or sorry, on the 120-minute chart, there is buy side liquidity above a particular high over here, this high, and we are looking for inversion to come in around this place. So while this is a immediate rebalance, price now after its destination has been reached has come back into it. So instead of seeing that resistance, I'm seeing that price is still pressing higher into that. So this is where it is basically heading up into. This portion is the hourly balanced price range. So if this is the balanced price range, it will not be a easy run for price to reach up into it. That's why you can see price is getting stalled midway into that. Over here, there is a immediate rebalance. You can see in these three candles, price has come down and touched the previous high over here. Now it is basically the buy side delivery that is on right now. The buy program began when the price went below this low, and from here now the price is going higher into buy side liquidity. So the initial buy side liquidity was above these two highs, and that is what we traded right now. Uh, the initial sell trade was based on the fact that after 8:30, price came lower below this swing low and it went higher, but it failed to go above this high. And this is the first fair value gap. So while it kept chopping around that level, over here I saw a clear, you can say, a close below that fair value gap. We have one up close candle here, and this is what I saw real time, that price has respected this as a resistance over here in these two candles when the wick went higher but the bodies closed lower. So this was indication for me that it wants to go lower. So if it has to go lower from here, where can it go to? The lowest hanging fruit is basically below this swing low. And if I look leftwards, I have these two lows over here. So this becomes the low hanging fruit over here, this low. And then just outside this reach is this swing low. So while I expect price to reach down for this low, I know that it may not deliver to this low. So it may get stalled in between. That's why I had my first partial taken out below these lows. And then the last one, once the price went below this low, I wanted to see if it can still further stretch down to this one. But I did not hold the entire position. I said, I'll take one more over here at the end of this golden belt. So I took one more micro off over here and held the last one to see if it can reach down to this low. And that is when I had taken my stop loss or lowered my stop loss further. So now I am in a free look basically. I don't want to, or I don't have any risk on this trade. I have booked partial profits plus I have, locked some profit in. So now when the position got stopped out, I was in no position to lose anything. Then I waited for price to give me its indication whether it wants to further go lower or it wants to go higher. So it showed me clearly that it doesn't want to respect this as resistance. This inefficiency, had it wanted to go lower, it should have come back up, just gone into this inefficiency, and again continued the sell side delivery. But it did not do so. It went through it and went back into this first fair value gap. Even from here, it can reverse and start going lower. That's why I did not, act on anything yet. I wanted to see a clear close above that, which was shown by this candle. When this candle closed higher over here, I knew that these highs are all relatively equal highs. Plus, we have this portion of inefficiency open. So price will now look for buy side delivery. And that's why I bought it here. And again, I just looked for a low hanging fruit that is this high. While I know that it can reach up into this, on this second trade, I was just holding one micro. So I wanted to take it out at the lowest low hanging fruit and not just keep stretching it higher. And that's how I managed the second trade. So that's about the trade and the management of it. Price has just fell short of that high which I had indicated, and it can still go to that high. For that, the price needs to be stalled at the midpoint of this belt over here. So this is the balanced price range. I don't want to see a close below that midpoint, like, on a closing basis, and it can still go higher up into this high. So that's for your observation. We can now continue with the discussion of economic calendar. So on the economic calendar now, I was trying to show how I schedule my trading hours based on this calendar. So for today, as I said, 8:30 to 9:30 is a good hour to trade in. Then let's look at for tomorrow. Tomorrow there is a news at 7, again at 7:30, and then at 8:30. Now this 8:30 news is a very high packed news, the consumer confidence. So if I have to trade, I will not look for a trade between 8 to 8:30. That is the first, we can say, first half an hour of opening range. So I will not be trading in the opening range. I'll wait for this news to be out and then see if I can uh, catch a move. I'll not be looking for any pre-market trade as well. So for tomorrow, again, this is same as the trading hours for today. So I'll just move it ahead, copy it over here. These are the timings when I'll be looking for a trade. For Wednesday, now Wednesday is the day just prior to the day when this high impact news, the FOMC statement, federal funds rate are going to be announced. So Wednesday is going to be a very choppy market. So it's better I stay out from this market. So I will not be looking for a trade on Wednesday. And take it in your notes also that whenever there is a very high impact news like this, FOMC statement, federal funds rate, unemployment numbers, or non-farm payroll, on those kinds of days, or CPI, PPI numbers, those high impact red folder events, they are going to bring in the choppiness in market just prior to their release. So it's better you avoid that chop. There are days when price is very, very clean. You can do that tape reading in a very relaxed manner. Like right now, there was hardly any confusion over here. Once I found the initial indication, I saw the price entered and targeted that low hanging fruit, and I was okay with it. Even when it turned, I knew that this is the buy side that it is targeting. It just changed its gears over here and it went over there. So this was a easier trade to flip on the other side. So this is the clean delivery of price, which will be found when you have just one single red folder event or medium impact, orange folder event. Those are the days when you should be looking for a trade. But now going ahead, you can observe what happens on Wednesday. You'll see the price chopping around both sides, and lot of traders would be frustrated with the price delivery. And I don't mean that you will not be able to find any trade over here, but these conditions are difficult to trade in. Someday you might come here and find a 20 to 40 points trade, and you would say that you told me not to trade, but see, I have made 40 points. That is basically um, just to keep you safe. I'm giving you those boundaries. Later on, once you are experienced, when you have a good hold of tape reading, you will be able to find those small little trades where you can easily find 20 handles, 30 handles, or 40 handles. But it's not going to be very easy. I want you to trade when the conditions are easy, and that's what I'm trying to define through this economic calendar. So it's better to stay out and just consider this as a holiday for you. Then plan any other activity for Wednesday and just leave trading out of your mind. So this is how, as a lifestyle, you can integrate trading into your life. You define your working times. So because now we have a very heavy calendar for Thursday, Wednesday is going to be a very tight range and it will be choppy. So it's better to stay out on Wednesday, take a holiday. Now, if you are going to trade on Thursday and Friday, you have to wait for all these news to be behind you. You don't want to sit in front of the charts while they are being released, because the kind of volatility that will happen while these news are released, it will be like within a minute the price would move like 20, 25 handles, 30 handles, and up and down both sides. So your stop loss of 10 handles may not be able to save you, even if you are right. Even if you guessed it right that it's going to go higher, those 10 handle stop losses are going to be triggered because of the volatility. You don't want to be in the markets while these news are being released. So that's how you stay out of the markets on these days. So for Thursday again, don't look for any trade prior to 8:30, or let's again mention you have a news at 9 o'clock. So you can wait until 9:30 to 10:30 hour for trading. You don't even look for any trade between 8:30 to 9:30. That's how you save yourself from any kind of chop that is going to happen. Let the price settle down, take its you know uh, time for stability, and then look for a trade. And for Friday again, we have employment numbers, and 8:15 is Chicago PMI. So we have the same hours when we can be looking for a trade on Friday. So this is how you should be looking or planning for your week ahead of the opening on the Monday. So not every Monday would be a trading day for you, but I have already outlined which kind of Mondays I look for trading. So if you have any questions, you can ask me now.
Sir, I had marked the previous week low and high and London session low high.
Hmm.
So now it is at the London session high जो अभी
Yes.
price चल रहा है. So is it important, मतलब है कुछ इसका importance?
London session is the overnight session for New Yorkers. So the people in New York, the traders, would not be trading during the London session. So this high is basically the London session high.
Yes, sir.
So London session is between 12:30 to 15:30.
3.
So this high is a significant high. That's why we have to mark it as buy side liquidity and sell side liquidity. So below London session low would be the sell side liquidity, and above that high would be the buy side liquidity. So that is basically the pool of liquidity which will be targeted by price. So right now, like I had indicated that that liquidity will be targeted. You can see I also indicated that this red belt, this is the balanced price range. So if it has to go higher, the midpoint of it should be respected because we have already gone through that range over here and closed above it. So when it is returning back down, it can stab below that midpoint, but I want to see those bodies respecting it. So none of the bodies had gone below that midpoint, and you can see the price was delivered above this high into this buy side liquidity. So this is the part of tape reading that I want you to learn and practice, because if you learn the tape reading, it will be easier to find your low hanging fruit and finding trades regularly. It's not a pattern or something, it is context around which the price is being delivered. So we know that there is buy side liquidity above market, but while it is going there, we want to see those signatures that price really wants to reach up over there. So like I wanted to see price go down for this low, and I was trying to tape read it while it was doing that. So the very first thing that I noted was this fair value gap was left open. I wanted it to remain open. Only then this was in the cards. If not, then it is not going down here, at least for now. And that is what happened. Now this first fair value gap of the R, that is 830 to 930 R, this is a kind of filter that I use for price to tell me that now, boss, this doesn't want to go lower. It wants to reach up for buy side liquidity. So if it is going for buy side liquidity, where is the lowest route available to me? This high. Above it, I know this is an inefficiency. Above it, I know there is buy side liquidity over here. But then I have to tape read it all along. So if this is the buy program, I told you you should look for down close candles to form and then respect the price and not allow price to go lower. So once it went higher, we had this down close candle forming over here. And I said, it's okay, don't worry. That was basically to tell you that this is not a reversal. This is a natural phenomenon. It has to form these down close candles as kind of a support. While the climber is going higher, he has to create some footholds. So this is one of those footholds. Then the price starts going higher, and then I said over here we have that immediate rebalance between this candle, and this candle. We can see that the first candle's high has been touched by the third candle's low. So we have a balancing act that has happened over here. So this gap will remain open, and now it should reach for the liquidity. So that liquidity is where it's above this high, the line that I had drawn earlier. So once that liquidity is reached, now this fair value gap is okay to be traded into. And that is what is happening right now.
So,
So it's a very controlled delivery of price. You have to understand how this is being done, and it's easier to read like this when the conditions are such. Like for today, I said 8:30 to 9:30 is the time period when the price delivery will be normal. It will be good. So this is where you can practice this kind of tape reading. But if you try to force yourself to trade in other time frames when this is not conducive, you will find that you are getting it wrong more than getting it right.
सर
और कुछ?
ठीक है
So I'll stop the recording here.
सर